Ladies and gentlemen, welcome to the correlation section. Really excited to put this together. We're finally here. So many people have been asking me about correlation over the last couple years. Been getting a lot of questions about correlation. People have heard me talking about it, using it in my trading, really wondering how to really get a handle on this. And I'm sure you know, it's not as simple as just opening up a couple of charts and looking for some correlation. It doesn't work like that. As with everything that you may have been led to believe, there's a lot going on in the background, and that's why we're here today. And I'm really happy and glad that I can finally shed some light on how institutions, obviously I've said it a million times, worked at some of the biggest institutions in the world, and the stuff I'm going to show you today in correlation, I've learned from there, right? I'm just plucked this out of thin air like a lot of people do. This is literally stuff I've been taught myself, and I'm really excited to pass on that knowledge to you. Obviously I've kind of layered it with my own understanding through years of screen time and developed my own understanding of it, which I'll bring to it. But yeah, ultimately you're going to get an amazing insight into how institutions look at correlation. It's very different. You won't be surprised to hear this. It is very different to what I see in the commercial space. I think most of you know kind of what correlation is, but you just don't know how to use it. How is it calculated? What does it mean? How should you be looking at it? All these things we're going to be answering today. So yes, well overdue. Really excited to put this together. You won't even notice it because you may have just come from the last section straight onto this one, but I have had quite a bit of a gap. I think the last video was the video where I showed you where I get all the research from, which was a fantastic video. Really happy with how that came out, and I've had amazing feedback from everyone. Don't think it's pretty much 100% positive, and I appreciate that. Having said that, let's be honest, it was fantastic, right? You got to see where you can get so much institutional knowledge for free. We're now going to build on top of that. But anyway, the point is, it's been a while, right, since I put that video together, about 6-7 weeks, almost 2 months break I've taken. Unfortunately, I had a death in the family. It seems to happen a lot. Foundation and Pro course, I obviously lost my pet, Tiger, as many of you know if you've watched the Pro Foundation course, who I had for a long time. I lost my grandmother, had to go to India, and I've just come back. Anyway, the point is not that. The point is I'm fresh, I'm eager, I'm ready to go. So I'm really excited to show you, what correlation is about. There's a reason, and what I'm going to say will only take 1 minute, and then we will crack on, but it is important. There's a reason I've started to explain this so late in the phase of your institutional journey. A lot of you have done Pro and Foundation, or you'll be on the Pro and Foundation right now. I don't want to overwhelm you with too much. You can see how much there is to learn in terms of fundamentals, how much there is to learn and get a basis in terms of order flow. Correlation is really a layer way above all of this that you can put on top of everything as you go along, and you build that foundation first, i.e. the things you're learning in Foundation and Pro, the things you learn in the early part of the fundamentals course, understanding the basics of fundamentals, understanding markets. There's no point in you understanding how markets co-vary and correlate with each other if you don't understand the markets themselves. So can you see why now is finally a good time for you to be learning about correlation? So if you skipped ahead and you're trying to do correlation, don't do that. Go back. This is towards the end of the course. We're getting now towards the end of the fundamentals course for a reason, because this is kind of the icing on the cake. Okay, so if you still are struggling with individual markets, don't jump ahead. Keep focusing, keep going back, keep practicing on individual markets. Once you feel comfortable with individual markets, makes sense, right? Then you can understand how they correlate to each other, because this is about market 1 and market 2. Okay, so again, it sounds obvious, but a lot of people do miss the obvious things in this game, and that's why they don't do so well. Don't make that mistake. Obviously this is going to be now looking at how these markets come together. So for example, it could be the ES, S&P 500, okay, and crude, right? It could be S&P 500 and bonds. It could be anything really. You can apply the principles I'm going to show you today to any markets that you're trading. You can look at crypto if you want. Crypto can be market 1 and S&P 500 can be market 2. It's unlimited the number of combinations you can look at. FX. You'll see I focus mainly on dollar yen in the FX pairs, and I'll tell you reasons for that. Bonds, crude oil, and S&P. Okay, and that is coming straight from my institutional experience and observing some of the best traders in the world and seeing what they did. At the end of the day, there's no point in me reinventing the wheel. Obviously, I'm going to do what they do. If I see people have success, I want that success. And if there's a blueprint there for me to have that success, then why would I do anything differently? Having said that, I understand some people do trade crypto markets, and you might want to compare that to the S&P 500. You might want to compare crypto to crude oil. You might want to, these relationships, it's your job to look for them. Hopefully you're realizing now, having done this fundamentals course, and if you're on the Pro Foundation journey, or you're just starting, or you've learned some other edge that you've developed, you will know that success only comes from being dynamic, right? You've got to have discretion. There's no such thing as some automated thing that works all the time. I mean, I've given you an underlying basis, obviously, with the, if you've done the Pro Foundation, the VWAP and the market profile and all the stuff that we looked at in the Pro Foundation and the Dome, or you might be working through it right now. The basis is there. I just mean interpretation will slightly need to be tweaked as markets change, right? And it's actually not that scary because it's not that much you have to change. But sometimes what I mean is relationships will come and go. And actually there's opportunity there. You just have to recognize it. You can't just be doing the same thing every day and assuming the same relationship every day. That's what I mean. Things can get very, very dangerous. So look at any combination of relationships you want, but monitor them and recognize when they're changing. And I'll show you how you can do that very easily. In fact, that's what today is about. So I've spoken a lot, but it's important. Everything I'm saying is very, very important. Let's actually crack on with it, right? So lots to get through, as I suggested there, with everything that I've said. A lot of stuff to get through. Really excited for you to just repeat, layer this on top of what you've already been doing. So I'm going to say it one more time because I don't want people to start getting too far ahead, right? It happens sometimes with the Pro and Foundation course where I said to people, spend some time on the Foundation section, then move on to the Pro. But obviously, humans being humans, I'm the same. And people keen to crack on, watch everything first and then go back and do it in their own way. I get that, but hopefully with this you won't do that, and you'll be patient about this because I'm going to be throwing a lot of stuff at you thick and fast, and I don't want you to be struggling with individual markets and then trying to figure out how they correlate. You're going to overwhelm yourself. That's why. It's because I care about your growth and I don't want you to stunt that by overwhelming yourself. But look, if you understand the individual markets very well, you're very comfortable with what you've been doing, you developing edge, be it through the Pro Foundation or through another means, you've worked your way through the fundamentals course, you understand everything I've explained in a lot of detail, circular flow, the FOMC, how everything puts together, you've done the dashboard, you've been updating it for some time, and you're comfortable with your individual market. It doesn't have to be the S&P 500, it can be anything that you trade, and you're comfortable, then you're ready for correlation. Okay, so that's very clear, right? Can't make that clearer. Hopefully you take that on board. Let's crack on with it. So what we're doing, lots to cover, right? What is it? What is correlation? We're going to talk about that. How do you calculate it? We're going to then think about a theoretical perspective when it comes to markets. In theory, what should happen? When dollar yen goes up, what impact should that have on other markets? When crude oil prices change, what impact should that have on other markets? When S&P 500 prices change, when FX, we already talked about dollar yen FX, but you know, when basically certain markets change, what correlation characteristics in theory should we see? Maybe some reasons for it. Very, very difficult. You know, there's a famous saying, correlation is not causation. We'll talk a little bit about that. But at the end of the day, does it really matter when it comes to markets? Yes and no. You know, to find the cause, as long as we understand the relationship and it helps us to develop some edge, alpha in the markets, then it's okay. But it is nice. It's a nice to have to at least understand why we might be seeing correlation. You know, there's this very well-known correlation between dollar yen and S&P 500. Is that down to something to do with, you know, local characteristics of the Japanese economy? Is that something to do with interest rates? Is that something to do with neither? Right? Those are the things that can be changing all the time. So I'll talk a little bit about, in theory, why correlation exists. Obviously, in practice, it will be different. Sometimes it will match theory, sometimes it won't. There'll be things happening, very dynamic, as I said. But all doable, okay? All doable. That's why you're on this course, and that's why you have enlisted my help. And as I've said many times throughout the course, I'm going to do my best, and I think we're going to have a fantastic session here, where you're definitely going to go away with hopefully 10 times more knowledge than you started with, okay? So let's get on with it. What is it? What is correlation? Why do I look at it? You know, what use or benefit can I get out of it? Let's start with a basic definition, right? So I've put this slide together. As with most of the fundamentals course, I'm actually going to try and avoid using slides. I think this is the only slide. I could be mistaken, but I think this is the only slide that I'm using. And then the rest, we're going to be very hands-on, practical. We're going to get on Excel. We're going to calculate correlation. We're going to get on the charts. I'm going to show you how I look at correlation on the charts. And so really, really, really exciting. But obviously with this part of it, the definition, I mean, definition is the definition. So many of you would have known this. I think pretty much everyone knows. Correlation is obviously about the relationship between two or more variables. I actually put here I just looked it up on the search engine. I think it was Oxford Dictionary came up with this. A mutual relationship or connection between two or more things, right? I mean, what else needs to be said? That is correlation. There was also another definition which is identical, just a slight variation of it. The process of, and I like this because this is what we're doing. The process of establishing a relationship or connection between two or more things, right? That is correlation. And this exists everywhere in life, right? And we're going to have a look at some examples. Infinite relationships where there is some correlation, right? Causation is different. We're not necessarily saying one causes the other, but there is a relationship between them, i.e. they tend to move together, right, in one way or the other, or opposite to each other in equal or some degree of equal movement, whether it be together or against each other. So, you know, the examples we've got that I've put together, it could be like when the temperature gets really hot, or where the weather is really hot, people buy more ice cream, right? So you could say there's a relationship. I'm just going to put ice, well, in fact I'll spell it out. Ice cream and the weather. Okay, and then when it's really cold, people buy less ice cream, right? So you might tend to see the, you know, if that's the temperature, right, and that's sales of ice cream, would you agree? You would expect to see sales go up as the temperature rises, sales go up, right? So you tend to see some sort of positive relationship. And we're going to have a look at all of this. And there are, I was going to say hundreds of thousands of relationships like this where you will see correlation, right? That's positive correlation. Okay. I mean, you know, you can think of it in your own time. You can even look for correlation relationships that exist in real life. There's so many. Just trying to think of some others, you know. The more frequently you go to the gym, right? I've literally just thought of this off the top of my head. Visits to the gym, number of visits. Can't even spell visits, sorry, visits to the gym, and then muscle mass, okay, or body fat, or obviously depending on what you're trying to achieve. Would you agree? The more you, it's going to be a positive relationship, basically, in pretty much all cases, unless you're lucky, right? Great genetics. Unfortunately, I don't have that, right? For me, it's a disaster. If I don't go to the gym, oh God, be a disaster. So I actually do have to go to the gym, like most of us probably. The more you go to the gym, the more muscle mass, or in fact, body fat will be a negative relationship, wouldn't it? So the more muscle mass you'll likely have, and actually it'll be a negative relationship between body fat and number of gym visits. Not always the case, because I tend to end up eating a lot after the gym, so the relationship breaks down. But in theory, the more you go to the gym, the lower your body fat. Okay, so it'd be like that. That would be the relationship, right? Okay. So actually be a negative correlation, right? So the more you go to the gym, so this would be a positive correlation, and that's a great example of a negative correlation. And don't worry, if you don't quite get it, nothing to worry about. We're going to go through all of this. We're actually going to now start to calculate it. We're going to have a look at some real life relationships. Think about why this is so important, these relationships, because what we're here to do, we're not here to be scientists and look at these relationships. If we were, that's what we do. But we are doing something similar. We're looking for the similar type of relationships in markets, right? You will see the same relationships. It could be crude oil and S&P 500. Do you see? A lot of the time when the S&P 500 rises, crude oil rises. Could be one driving the other. Right? It doesn't matter. End of the day, there is a relationship there. We can exploit it as traders. If the crude oil price is rising and S&P 500 is rising at the same time, we're going to have what? Same relationship as the number of visits to the gym and muscle mass. A positive relationship. We're going to have a positive relationship, right? We need to be able to measure that. Sometimes it's going to be very, very strong, right? Sometimes it's going to be... So what I mean by that is, and you're going to see these scatter plots, we're going to do them together. Sometimes it might not be so clear. Sometimes crude oil might shoot up and the S&P doesn't. S&P crude. Right, so you might have some outliers. Okay, so generally it will be quite a, this type of positive relationship, but sometimes you might get these outliers. Right, and therefore it makes it trickier for us to use maybe movement in crude to predict the movement in the S&P. The correlation will be lower. But how do we know that? With the naked eye, sometimes it's very hard to tell. Markets are moving very fast. We need to understand different measures of how to tell these apart. Is this particular relationship at this point in time between crude oil and S&P stronger than this relationship between, this could be like a January, this could be February. They look quite similar to the naked eye, what I've drawn out here and what I've drawn out here, but are they? Is there any variance in terms of the strength of those relationships? So that's something we're going to be looking at today. But the point is, before we move on and we're going to start getting on Excel and we're going to start calculating some stuff, can you see why it's so useful? Right? And this could be anything. I just want to repeat that. Right? It could be crypto, okay, versus the S&P 500. Okay, so as S&P rises, crypto rises, right? So you tend to see this positive relationship between the two of them. It could be dollar yen, it could be FX, it could be yields, bond yields versus the S&P 500. And again, if this doesn't make sense, don't worry, it will as we go along. This could be a negative relationship. Sometimes they're negative, right? So, as interest rates become very expensive, things start to become expensive for people, they don't spend so much, it can make stock prices go down. So actually, as bond yields go up, stock prices go down. So you tend to see this type of relationship, this negative slope between the two of them. Okay, so bond yield rises and S&P 500 prices go down. Okay, so that'll be a negative relationship. And you can see, and again, don't worry, I'm gonna get into a lot of this, right? So don't worry if these drawings I'm doing make no sense to you whatsoever. Don't worry, we're gonna get into it, and I'm gonna show you how to look at this on a chart as well, that you may be more familiar with. Can you see how this can actually help us in our trading? Because if you think about it, let's say you're a crypto trader. We know the relationship is positive. If the S&P relationship is positive at a given moment in time like this, S&P 500 prices are going up, and you see that, you don't really want to be short of the crypto market at the same time. Or you at least want to be questioning why you're short if you're short. Like I said, you've got to be a little bit careful, right? This is just a layer on top of another 10, 20 things you might be looking at. You know, the relationship may be about to break down. So I'm not saying you want to get out of your trade, but at least you want to question why you're in the trade, right? And if everything else that you're looking at doesn't look as supportive, and then you're going against the correlation relationship as well, can you see? You may want to exit. If you're looking to buy crypto and you're looking for reasons to buy and you have certain supportive factors, and then you see the S&P rising, you see, you may want to actually get into crypto. Similarly with S&P and crude oil, you know, if you see crude oil having a positive relationship with the S&P, i.e. recently as crude oil has been rising, the S&P has also been rising, you see the crude oil market starting to rally on a particular morning, and you're thinking about getting long of the S&P, it may give you that extra confidence to get into the market. Okay, so obviously we don't go around drawing these little, you know, everyone knows the famous Epic pen that I use here, right, especially if you've done the Pro Foundation. If you haven't, I use Epic pen. Okay, that's what I use. Point is, we don't go around drawing these relationships by hand. Okay, I'm going to show you how I use Sierra chart, as many of you know. I do use it to help me see the relationship. I'm not going to sit here and draw it, okay? I'm only doing it now because, as with everything that I've taught you, I don't want you to just think of this as an indicator. It isn't. That's where people fall down. They just rely on things telling. If you don't go through this at least once, calculating it yourself, if you've done the Pro and Foundation course, if you saw how much detail I went into to calculate standard deviations, I didn't just give you standard deviation. I said you've got to calculate standard deviation so that you understand. When you do have your platform calculating it for you, what is it actually calculating? You're not just taking its word for it. Same with correlation. Yeah, I look at correlation, I visualize it, but I also have a number for correlation, as you're going to see, to give me the strength of correlation. I'm not just, you know, taking the platform's word for it. I actually understand it because I've actually done the work to calculate it at least a few times myself. And then you don't need to after that. Once you understand it, then okay, you can start to just be a little more automated about the output, but at least do the exercises once. Okay, so that's what we're going to do now. We're actually going to calculate correlation between two variables. We're going to look at all sorts of different variables. You're going to become very good at calculating and understanding how correlation is calculated throughout the statistical community. It's very similar to standard deviation. We're going to have a look at that now, so let's get into it. Okay, so what I've done, the background must have just switched up there, but all I did is I just loaded up the dashboard. Okay, so your fundamentals dashboard, you've obviously built that in part one. If you haven't, do the section, finish everything, stop this video, come back to it later. The markets are not going anywhere. If you've done it, great job, load it up. I want you to, what we're going to do is we're going to calculate correlation. We're going to really get deep into correlation before we get on the charts. We will do that eventually. We're going to really understand what correlation is. We've already said it's the relationship between two or more variables and how interrelated they are to each other. You know, do they move together? Do they move in opposite directions to any degree? Is there any relationship we can find between two variables to exploit, or obviously for us to make profit, or scientific community will be doing it for the variety of reasons, obviously to see if there's any relationships that can help them make decisions, right? As we've talked about throughout, we even talked about it in the fundamentals sections where we talked about why the FOMC does certain things, why we have economic data, right? Why do we have economic data? Yes, for us as traders it's great, but it's actually much more important for governments, for organizations such as the Federal Open Market Committee, because they can make decisions from that, right? So it's the same for all these communities that might be using correlation. They'll be using that to make decisions, right? So, you know, a typical example, and I'm going completely off topic here, but I would just want you to recognize how important correlation is, not only in markets. We sometimes get so obsessed about markets and think everything is about financial markets and trading. It isn't. You know, trading is, okay, great. You know, I'm very fortunate. Full-time trading, great income, allowed me to live a good life. But the reality is, I'm not naive. I know that all these things that we think impact trading, like economic data, correlation that we're going to look at today, actually has a much larger impact on general day-to-day life. So what I mean by that is, you know, scientists could be looking for correlation in, and don't ask me why, I literally just thought of this example, you know, in sea life. So like marine life, you know, like fish or other types of aquamarine creatures, and they could be looking for correlation between certain types of diet and weight in those particular species, right? Is that diet good? Well, let's have a look at the impact, the correlation, right? Or certain type of, you know, we give them this medicine, or you see what I mean? There's so many ways that data then can be used by biologists, like marine biologists, to improve the life of ecosystems. Do you see? I mean, I'm going off on a tangent here, but it's so true. I just want to put things in perspective that, you know, correlation isn't just about financial markets, and actually I just want you to realize it's used everywhere. However, we can also use it as well, right? Okay, you know, it is what it is. We obviously going to use it for probably a less noble cause than a lot of these scientists are doing. Nevertheless, the reason I'm saying all of this, because I want you to realize how similar it is. You know, I talked about standard deviations. We're applying all of these methodologies that institutions are using in markets. When you looked at the Pro and Foundation course, we need to recognize why it's so powerful and why institutions are using them, because they're not just random, and I've said this so many times, they're not just random squiggly line rubbish that I see in retail and you see nowhere else. This is stuff you actually see being used by the wider community, right? And that's why it's so powerful. So it's twofold. Yes, there's the moral thing that I probably went off on a tangent on there, but there's also the thing that should give you some confidence that actually, yeah, let me look at this, because actually it is a, you know, a powerful methodology of actually taking advantage of a relationship between two financial markets, because actually the same methodologies are being used in the open world, right, to this day, and in front of us all the time. Okay, so very, very important. And you might be thinking, Envy, you're just waffling on here. I'm not, because you're going to see, we're going to look at relationships that have nothing to do with markets. So, and eventually we'll apply them and relate them to markets, and then we'll get on to markets. Okay, so what I want you to do, you can just, so you've got all your tabs from before, right? We're not going to bother with any of that. This is completely new, something completely new. I want you to click on new sheet. Okay, so I've already done that here. I've got sheet 2, but click on new sheet. I'm going to close this one, delete that. Okay, so I got my sheet. I'm going to call it correlation. Call it whatever you want. Correlation. Okay, and I will look up quite a bit, so forgive me, because I just want to make sure I'm not blocking anything, because I know I'm in front of here, isn't it? Some of these Excel sheets, and I'm going to put some data there. So what I want to start with, I've actually created some data I got off the internet somewhere, just found it randomly, but a lot of it I've actually made up myself, and I want you to do that. Okay, you don't have to use the same data I do, but I'm going to start with something. So what I want you to do, data, what is it? View, isn't it? View and grid lines. You don't have to get, as you know from the previous tables I've been making throughout the course, I like to get rid of the grid lines. What I'm going to do is I am going to just cheat a little bit, because obviously I don't want to sit here typing all this out. I want you to type this out. If you want me to send it to you, I can, but ideally I think it's better for you to type this out. I'm going to copy it, okay? So you see I've copied this from somewhere. I don't want you to do that. I want you to actually type this out. Okay, so this is some data. Okay, so for all intents and purposes, our intents and purposes, someone's gone out and actually collected this data. And this is my point why I was going on and on about scientists looking for correlation, and because they're doing real world experiments, right? So this is slightly different. This is more a corporate experiment, right? It could be an ice cream company looking to use this to their advantage. Do you see? It doesn't have to be financial markets. This could be S&P 500 and crude oil, but it's actually the temperature and ice cream sales. The same way we as traders are looking to take advantage of this type of relationship between two markets, businesses are using correlation all the time in the same way we are, but with two different variables. They might be looking at temperature and ice cream sales, could be an ice cream company, to help them decide on output, right? Stock levels, output, depending on weather forecasts. But to do that, they need to know what's the correlation between weather and ice cream sales. So they may go and collect this data, okay? Now I think I found this data somewhere. It really doesn't matter. You can make it up if you want. Sorry, let me just clean this up a little bit. Okay, there we go. I want you to pause the video and I want you to think, what would you expect the relationship, the correlation between temperature and ice cream sales to be? Okay, have a think about it. As the temperature rises, do you expect people to buy more ice cream, or do you expect them to buy less ice cream, or do you think there'll be no connection? Right, because we can also have no correlation. There'll be lots of examples where, and I'm going to show you one you'll see later, you know, someone's shoe size or weight, right, how much they weigh and how well they do in an academic test. So it's going to have no relationship, right? It don't matter if you wear bigger shoes, it's not going to make you more clever, right? I mean, I don't think it would anyway. And I think if you did the experiment, you would find very little correlation. There wouldn't be much. In fact, zero, I would suggest. Whereas something like this, to me, I don't know about you, but I will think that as it's hotter, people will buy more ice cream to cool them down. Okay, so this is, I don't know if this was an actual experiment done. I found it somewhere on the internet. But the first thing people do to measure correlation, to try and find out is there correlation, is they plot it on a chart. Because otherwise, look, how can you really visualize any of this data? Okay, so I want you to write this data down, of course. And then what I want you to do is insert a chart. Okay, so it's this one. Insert scatter. Okay. Scatter. Okay. Can you see it's done it for us already? Really, it's done it. Ice cream sales. Okay. So I don't know on your Excel what version you've got, but it may say insert chart, recommended charts, all charts. Look for this one, XY, scatter. Okay, that's the one you want. Because you want to be able to see how they are interrelated. Okay, you don't want to have a line chart as of yet, because otherwise you're going to have lines going all over the place, because it's not always going to be a clear relationship like this. Sometimes it might be all over the place. So this is currently the relationship according to this data. Is it any surprise? I don't think it is, but let's just clean it up a little bit. So what I'm going to do here, so on the x-axis, I'm not going to label it and get as technical as we did with some of the data when we were doing the economic data, because we're not going to be using this. This is just showing you this so you understand correlation, okay, and how correlation is calculated. Because even when we get on the charts, I'm going to get the system, my platform, right? Obviously your platform should be able to do it, but I'll show you how I do it on my Sierra chart anyway. I'm going to get the system to calculate correlation for me. And I don't want you to just see it as a number. as with everything else. I want you to calculate correlation yourself, so you know when the system spits it out as you're trading, what it's actually telling you. Now to do that, we need to plot the relationship between temperature and ice cream sales. Okay, so I'm not going to be too neat. I could put the legends here. I'm not going to bother. So clearly this is ice cream sales. Okay, it could be dollars, pounds, it doesn't matter. Let's just say it's dollars, right? So this is ice cream sales. Okay, and this is the temperature. Can you see what's happening? As the temperature rises, what's happening? We're making more sales. Can you see that? Right? Do you see? 25, much higher sales. Similar to what I was drawing on the PowerPoint slide at the start, you know, where I was saying as the S&P goes up, higher prices, crypto or crude oil tends to go up. Okay, and you remember I was drawing a line like that? That's exactly what I was saying. Okay, so you may expect to see those dots I was drawing. It's exactly that. All right. So you can see how similar it is. You know, relationships between markets, two variables. Don't matter if it's S&P and crude, or whether it's the temperature and ice cream sales. Right? It's the same methodology we're using to see if there's a relationship. So what we're going to do, we're actually going to do some calculations ourselves so you can understand this. Right? So I'm just going to clean this up a little bit. Okay, so I'm going to double click on that. You can also go to format axis if you want, and you see it doesn't actually start the temperature until around 10 degrees. So just to make it a little bit cleaner, just give me a second, I'm going to change that to 10, minimum 10, hit enter. Do you see it just makes it a little bit clearer for me? I prefer it like that, so I can see this positive relationship. Again, no surprise, right? The more the temperature rises here, okay, the more the sales go up. And I'm actually not putting the axes here because I'm just trying to save a little bit of space, because you're going to see we're going to do quite a few examples. And I do want to leave a little bit of space, okay? So just remember, that is ice cream sales. You can see it here in dollars. So like $700 worth of sales when the temperature was very hot, like 26. Obviously, where you live, 26 may not be, but I'm from the UK, 26 is scorching for us. You may live in like Australia or another hot country where 26 is basically freezing, right? But you get the gist. Basically, there's a very positive relationship between the two. Now, what I'm going to do, we're going to have a look at a few other examples together, okay? And then we're going to do some calculations. So let's bring in a few examples, actually. So let's actually think about, so I've got these from before. And actually what I'm going to do is I'm going to get you to think a little bit before I actually just give you the examples. So I've got here, and I did actually make this up, but I've no doubt if you went and did this in a survey, you know, obviously I'm not going to go out there and do a survey. As much as I love you guys, you know, I'm not going to go and do a survey. People will think I'm completely crazy anyway, and it'll take me months. It might take me 2-3 years to do a survey. So I'm just going to use logic. But let's say someone's age, in terms of their driving, right? So a driver's age and the number of accidents per 100 that happen. Would you expect there to be a relationship between someone's age as a driver and the number of accidents that happen? Okay, pause it, think about it. Or do you think there'll be no relationship? Do you think there'll be a negative relationship? Do you think there will be, when I say negative relationship, I mean, so for example, right, how have I plotted this? Okay, so that is age, okay, and accidents. Positive would be that, right? So like that, positive relationship. As people get older, do you think they have more accidents? That would be a positive relationship. Or do you think as people get older, they have less accidents? Negative. Have a think about it. Pause it and think which one. Or do you think there's no relationship? Basically, it's all over the place. Different rates of accidents, no matter what the age. It's just all over the place. Okay, what do you think? I personally think, as much as I was a young guy myself, I actually think as you get older, you tend to get safer. You're more cautious. So probably it's going to be a negative relationship. There's going to be less accidents as you get older. Okay, so again, you can source the data, you can look on internet for different types of data. It doesn't have to be what I'm looking at here. Look for it. You'll see so much out there in terms of relationships. I'm just giving you my own examples. I want you to do some work and actually, look for your own examples as well. For now, stick to mine. Obviously do mine, and I might just have covered some of that with my head. Yeah, I have, haven't I? You'll have to forgive me, okay? I'm going to make this a little bit smaller in a second, but if you just pause the video and actually take that data, hopefully you can see it, okay, the data there. Just take that, or you can ask me for this. I don't know if I'll put it in the downloads. I may put it, I haven't decided yet. Not because I don't want to, I mean, there's no secret here, right? It's just made up data, but it's just that I haven't decided if I want to force you to do it. I think I would rather you actually did it. But obviously if loads of people struggle and say, Anvi, please, can you just send it to me? Then I might just stick it in there. Or just email me and I'll be happy to send it to you, okay? I'll save it on my drive. But otherwise, type it out. It's good for you. I want you to get used to typing out these relationships because you're going to learn that way. Now what you can do, and make it very easy for you, just copy. I want you to paste that, okay? So what I did there, let me show you. I just did copy, okay? And then you have to pick a cell. Don't hit paste yet because otherwise it will paste it on top of the original. Do you see I just selected a cell and then paste? See that I pasted that? Okay. I'm going to use this graph to look for the relationship between these two. So select data. You should be quite familiar with this if you've built the dashboard. Okay, edit ice cream cells, because I don't want ice cream cells anymore. I want accidents now. I'm changing it. Edit. Okay, so the name, can you see at the moment it's ice cream sales versus temperature? I want it to be accidents. So I click on accidents. Okay, you saw that? And then the x-axis, can you see it's got temperature? I don't want it to be temperature. I want it to be age. So I'm going to just highlight all the ages. Okay. And then Y values, I don't want it to be sales. I'm not comparing it to sales, I'm comparing it to accidents now. I'm going to move my head a little bit. Okay, I'm going to select accidents. And I'll hit OK. Okay, can you see? You can already start to see that negative relationship I talked about. You see, as you get older, less accidents. I'm just going to clear up this axis, format axis. Okay. You see I'm going to start at, let's start at 16. I probably started a bit young. I don't know any country where they allow you to drive at, in fact in the UK it was 17. I got my license at 17. I think they've changed it now, haven't they, to 18 or something. Some countries are 21. It's a bit older, but anyway, let's just put 16. Okay, in fact let's make it 15. Obviously you can't drive at 15. I'll make it 14 just so there's a little gap at the start, just so it neatens it up. Do you see that? It's a negative relationship. Okay, so what does that mean? That means the correlation is negative. The relationship between the variables is negative. Remember the definition that we put on the first slide? It's looking for the relationship. The correlation is looking or seeking for a relationship between two variables. So age, and forgive me, I haven't put, you can put the axis. We're not going to be using this long term. That's why I'm not being so neat. And the accidents. Accidents per 100. So is it any surprise? There's a negative relationship, right? What that means is the older you get, the less accidents we see from that age group happening. Can you see why I said a lot of what I said before I started this Excel, and I was talking about how marine biologists, and I was going off on one. Can you see why there's actually a much bigger cause or group of people using this type of relationship than traders? That's what I meant. Much more important group of people using these type of statistics. Think about it. It could be the government having they're doing a road safety campaign, and they need some evidence, right? Who to target? Who do we target more? Do we target youngsters more? Well, we need some evidence that actually youngsters tend to have higher accident rates. Do we have that? No, let's go and find that relationship. Okay, so that's what they're doing. They're looking for a relationship that shows that actually, yes, when you're younger, you tend to have more accidents. And that's what we're seeing here. More accidents, and as you get older, tends to. So that's a negative relationship as opposed to a positive relationship. Similar to what I said at in the start, you know, you might have bond yields versus the S&P 500. We see it with foreign exchange, but we tend to see more of a positive relationship. As yields go up, we tend to see things like pound, yen, and, you know, high yielding currencies go up. In terms of the S&P, we may see a negative relationship. Why is that? Because as interest rates go up, we tend to see GDP go down. It's not a linear relationship by any means. Obviously, it depends on the absolute. You know, if interest rates are going up from 0% or 1%, it's not going to have such an impact on GDP. But if interest rates are at 4 or 5% and then they suddenly jump to 7%, that's going to have a much bigger impact on GDP, which means what? People are going to be spending less money. You should be an expert at this now with the circular flow. They're going to be spending less money. Corporates are doing what? They're going to be making less money, right? So their stock price is going to go down. So the S&P is going to do what? Go down. Do you see that? As yields go up, same as, as yields go up, the S&P tends to go down. Similar type of relationship here. So as the ages down, accidents tend to go up. Now, we don't know if one causes the other, okay? We have no sort of, we can't be certain just because the relationship exists. That's why I kind of hesitated there slightly, because I did assume, that it's age basically that is driving the accident number. We can't say for certain, but logic would suggest it is. In the same way, we think that yields are actually driving the S&P to go lower, rather than the S&P collapsing, causing yields to go up. Okay, because it's less likely, and this is where you will, as a fundamental trader, as an institutional trader, you really have to use your own logic, and you've seen that throughout. You'll have to use your own interpretation, but you'll become very good at it afterwards. After you've done it a few times, a lot of it, I wouldn't say is obvious, but you've got to apply some logic. There's no indicator. This is why people use all that stuff. They're doomed, completely doomed. You're never going to make money. You have to use a little bit of, and I don't mean this in a rude way, but grey matter, right? Just the same way you do in any job, right? You couldn't just turn up to work and just sit there and expect to do nothing, right? I mean, you need to think about these relationships and why they're happening, and that's fine. Right? I mean, in a way, does it really matter? Like I said at the start, the causality thing, which we'll talk about a little bit afterwards, I don't think it's as important as establishing the relationship. What do I mean is, basically here, it's more likely to be yields going up driving the S&P to go down than the other way around. Because think about it, if the S&P is collapsing, why would the FOMC think, hey, let's raise interest rates? Obviously, they're more likely to lower interest rates. Do you see? So it's more likely to be decisions on interest rates that cause the S&P to move. And we saw that. I talked about it for hours throughout the course. FOMC decisions will drive the markets, right? Rather than the other way around. We will sometimes see times, obviously, where the S&P has a huge collapse, and obviously the FOMC will take that into account. But typically it's the other way around, right? And that's for you to judge. You'll obviously need to observe that and decide for yourself which way it's happening. I personally, and we'll talk a little bit about this afterwards, I personally don't worry about that too much. End of the day, I see the relationship. I only care that there is a relationship, and I'm going to take advantage of it. Why it's happening sometimes can obviously be useful, because you can look for clues for those things to continue to happen, but generally the main thing is establishing the relationship. If you don't establish this relationship, how are you going to take advantage of it? Okay, first most important thing is establish the relationship. So let's look at a few more examples. Apologies, I took a little bit of time just doing that slowly because I did want to just make sure that everyone is getting it. We're going to look at a few more examples and then we're going to compare them together. So I've got one here. Just realised I've got one for the S&P 500 and crude oil. I've actually just made up these numbers, alright? So you can make them up yourself if you want, or you can get actual data. It really doesn't matter. The relationship does tend to change a lot, as you're going to see when we actually compare S&P 500 and crude oil. I'm just going to move this in a little bit if you don't mind. S&P 500 and crude oil. Okay. And similarly, what we're going to do, I'm going to move this over a little bit and you'll see why in a moment, because we're going to do some calculations of correlation looking at the strength of relationship. Copy that. In fact, sorry about this. I'm going to move this up. Okay. I'm not going to be as neat as I was with the dashboard because we're not... this isn't going to be something we're going to be using permanently. I'm going to do this once with you and then I'm not going to look at it again. I'm just doing this to help you understand why correlation is calculated the way it is, which will make a lot of sense in a moment. So just bear with me. Copy. Okay, so hopefully you're doing this along with me. Paste. Okay, and what we're going to do, select data. Okay, we're going to change. We don't want ice cream sales. We can change the name from ice cream sales to crude oil. Okay. X values. So at the moment, can you see it's selecting temperature? I want it to be S&P 500 on the x-axis. And you see it's got ice cream sales. I want that to be crude oil on the y-axis. Okay. Can you see I just need to change the... because it's starting at 0. It's got the S&P at 0. I'm going to change that to... let's see what we've got here. 4,000. Let's go to 4,000. Right. Again, you don't have to do exactly what I'm doing, but something. Or let's do 4,400. Yeah, it's better. And then let's do crude between, I don't know, 60 and 140. Come out of that. There you go. Can you see it's quite a positive relationship? What that means is, so that's the S&P at the bottom. And I keep saying it, forgive me for not putting these axes in, but like I said, I'm just being a little bit rough. That's crude oil, that's S&P. What's happening here? Is it positive or negative? Positive, right? As the S&P rises, crude oil rises. Again, the causality we don't know. Is crude oil rising causing the S&P to go up? Is S&P going up causing crude oil to go up? I'm telling you from experience, typically it tends to be the S&P watching crude, because crude is very, very volatile and you're likely to get more volatile moves in crude than you do in the S&P, and therefore S&P traders, institutional traders, algorithms, they'll be watching crude oil. So it's typically likely to be oil, but it doesn't really matter. Establish the relationship and take advantage of it. Worry about whys afterwards. The main thing is to establish this. You know, if you don't know, or you're guessing, or you think it's a negative relationship, who cares if you know why? Which one is driving which? You got the relationship wrong. You're doomed, right? So this is the most important thing. So here we've established in this particular point in time, this example, this may be a one particular month. It could be a particular day. We don't know, but the point is that it's a positive relationship. As crude oil goes up, what happens to the S&P? Goes up. As S&P goes up, what happens to crude oil? It goes up. Do you see? No different to this. Ice cream sales. What's the difference? As the temperature rises, what happens to sales? They go up. Do you see, there's a relationship between them. There's a relationship between them. That is correlation. We've still got a big step to go, but I'm going to show you how to calculate correlation, how the scientific community, how organizations calculate an accepted form of correlation. It's very similar to standard deviation, and I'm going to talk about that in a moment. Variance and standard deviation, which I went into incredible detail in the pro course about, and I am going to tell you to go back and visit the pro course in a moment, but let's just get all these examples down first. Okay, so next one we're going to have a look at. Okay, there's just 2 or 3 more and then we're done, because I do want to do them all together, and then we've got the basis for doing all the calculations. So another interesting one, right? I want you to think about this. You can pause the video. If you've got ads, right, you go to the cinema and you've got ads playing, you know, adverts playing, and I'm looking at the relationship between the length of the advert, which I'm going to put here, adverts, length, and the rating people give to adverts. Typically people hate adverts, right? But would you agree, what do you think? If an advert's very short, is someone likely to give it a higher rating? So therefore we would get this negative relationship, kind of like this accidents per 100 versus age. You know, as age goes up, accidents tend to go down. As advert lengths go up, you know, it starts to become a long advert. I'm giving you a hint here. Long and boring advert. Actually, ratings drop. That's what you'd expect, right? A negative relationship. Let's have a look. Okay. Now again, I'll be honest with you. A lot of this data is just made up. I mean, who's going to go? I'm not going to go to the cinema and start asking people. Well, this is the reality. This is probably what you would get, right? So I'm not worried that it's some fictitious data I've made up. I'm doing it to prove a point to you. There probably are cinemas and movie makers that do this and have this real data. And if you ask them for it, I have no doubt that it's going to give you the same result. So I copied and pasted that, select data. And like I said, you can go out and find your own real examples of this type of positive or negative correlation. You're going to find the same stuff. Okay. Average rating on the series name, the X is what? No longer S&P 500, is add length. Okay, Y values are what? No longer crude oil, they're the average rating. Hit enter. Okay, there you go. Now we do need to play around with these axes because it is using the same as crude oil. So format axes on the Y. What have we got? 0 to 10. I hit reset, it's got 0 to 12. That's fine, we'll leave that. And the x-axis, which is add length, goes from, in seconds, 16 to 27. So let's change that. So if you click on that, reset it. 0 to 30, let's do 15 to 30 and hit OK. There you go. Come out of that. There you go, look at that. Any sort of surprise? Not really. Do you see? The shorter, so this is add length, this plotted against the rating. You know, what do people give it? I mean, I doubt anyone would actually give it a 10, but okay, fine, they gave it a 10. Must have been a great advert, or very short. But it makes sense, right? Rating. The shorter the ad, the more people like it. Probably because they just want it over and done with, but whatever the reason. And it's a negative relationship. Can you see? Very similar to yields, bond yields, and S&P. Right, remember? The higher yields are, right, the lower the S&P price. Okay, the higher, and in fact here we could argue that causation happens from the ad length, right? So the other way around, the shorter the ad length, typically the higher the rating. But again, we're not here to establish causality, we're here to establish a relationship. And the point is, the relationship is, the higher the rating tends to be for shorter ad lengths, the higher the yield tends to be for lower S&P prices. So the relationship is negative. Negative relationship. Negative relationship. This is a negative relationship. That's a negative relationship. This is a negative relationship. This is a positive relationship. A positive relationship. This is correlation. So we're going to look at a couple more very quick examples. I want you to go very slowly with this. Okay, I'm going to shoot through them quite quickly just so I can get them down, and you'll see why, because we're going to do some calculations. Okay, so I want you to now look at shoe size. Okay, I'm actually helping you. I'm giving you a variety of examples, so it's not just positive or negative. I'm giving you all sorts of examples. Okay, so this is shoe size and scoring test. Again, you can pause. I want you to type all this data out. You can type all this out. I'm not going to help you format it and put it how I have, because you've done it already. You should be experts in formatting, and you already know I like this style. You know how to do it. You should know how to do it. If not, go back to the previous sections and obviously just see how I was doing the formatting in black at the top and so on. Copy the chart down, paste. Okay, so we're no longer looking at this average rating and ad length. We're now looking at shoe size and scoring test. So let's select data, edit. Okay, no longer average rating. Now we're now looking at scoring test. X values, instead of ad length, we're looking at shoe size. Okay, and instead of average rating, we're looking at scoring test. Hit OK. Don't worry, we'll sort out the, just hit OK. We'll sort out the axes. Okay, so shoe size is on the X axis here. So if you just format axis, it's because we copied it from above. It's got the old setting, so 0 to 18, but it's actually at 5 to 16. So let's start at 4. It's up to you what you put here. I just don't want it to start right at the edge. I want there to be a little bit of a gap. And then the y-axis, format, had it up, didn't I? So format axis, okay, so this one. 0 to 100, we don't want 0 to 100. We got like 60 to 100. We got maybe 50 to 100. Okay. Before I reveal that, actually, what I should have asked you, would you expect to see any relationship between someone's shoe size and how well they do in a test? Assuming they're all adults. Okay, I'm not talking about children versus, I'm talking, let's say everyone was the same age, 30-year-old, all 30-year-olds, would you expect to see any relationship between how their shoe size was or not? I would argue there is no relationship. Let's have a look at what the data, let's imagine someone did this survey and they've asked people with these different shoe sizes. Is it any surprise that's how we come out? There's no relationship. This is what I'm hoping you're starting to see now. Can you see why these scatter plots are what statisticians or people doing these experiments in real life, even institutional traders, will be looking at relationships in this way? And I'll show you. Obviously, I don't really look at scatter plots. I let the platform do the calculations of this scatter plot and the correlation for me. But the point is, I understand that that's what it's doing. And this is where I see people fall apart when they're looking at correlation. And no offense, I've said this many times. I don't really pick on any particular retail subset or educators or groups of traders. I don't care. Okay, I really don't. I'm saying this to make you better. I think the reason that a lot of people and even in institutions, to be fair, when I saw new traders coming through trying to figure out correlation, I think a lot of people fall down because they just let the platform tell them stuff. Okay, I don't do that. I want to understand. If a platform's telling me something and it's telling me there's very little correlation, what does that mean? Well, okay, it's giving me the relationship where the two variables are being plotted, probably something like this, where there's very little correlation. Can you see there's very little relationship here between shoe size? I'm sorry, I should have put on all of these are all the x-axis, okay, and that's the y. So that's y and x, okay, y and x. It's always x here, x, okay, so this column always goes into there, the x, and this column goes into the y. Sorry, I should label them, but I don't. Apologies. It's a little bit bad of me not to put the labeling. I should really put the labeling on, but I don't. But can you see here, clear negative. Where am I here? It's all over the place. I can't find any relationship. It's literally like that. It's all over the place. I can't find any. There's no relationship, basically. They're all over the place. If I try to find a line of best fit, a linear line of best fit, to find some sort of linear relationship, I'll be all over the place. It might be something like that. I don't know. So, basically there's no relationship. I have very little correlation, and I hope you can see that. And I'm going to just labor the point. It's so important that you see the difference. Positive, negative. Can you see how different the scatter plot is when you plot them against each other? Just because shoe size goes up, I don't see, as we go along the x-axis and we see shoe sizes going up, I don't see that jumping. Do you see, there's also people with high shoe sizes that have low tests and high. It's very mixed. There's people with high shoe sizes that have low and high test marks. There's people with low shoe sizes that have high and low test marks. It's all over the place. There's no relationship. Okay. Now, there are literally 2 more. Okay, I'm going to copy them down. I'm not going to say much about them because they are repeats. So I want you to see that. Sometimes you gather data and they're going to be very similar. And there's a reason why I'm doing this, because I want you to see, and I know I'm covering that. So I'm just going to scroll up a little bit. Okay, there you go. You should be able to see that now. Copy this. I'm going to do this really quickly. Okay, copy, paste. Okay. You see, right now it's selecting that data. I don't want it to. I want it to select this data. Don't forget, you'll have to pause and just type this data out here. You'll see it's slightly different. Data. It's just a different age group, but it's telling me the same thing. So before it was 16 to 27-year-olds. I'm now looking at 32-year-olds to 54-year-olds to see if there's any relationship in terms of accidents, car accidents. Sorry, so this isn't it. X-axis is that. And the Y-axis is that, accidents. Should be a similar picture. Right, it should be a similar picture. Okay, there we go. So what did I do here? 14 to 28. Let me just change this. Reset that. 0 to 60. Now let's go 30. There you go. Okay, can you see how similar that is? The number of accidents per 100 people of a certain age group, as the age group changes, as the age rises, right, we tend to see less accidents. We're seeing the same. Now people over 30, 35, 40, 45, 50, 55, do you see how it drops off? The number of accidents they're having. In fact, let's change that to 55, because we don't have any data there for 60-year-olds, so let's change that to 55. Okay. Can you see? Very similar relationship. Is there any surprise? Negative. Do you see what I've done here? Is I've brought the same data, but a different sample. It's not always going to be the same results. You might ask a different bunch of 16, 17, and then that data comes through, and I'm comparing them. There's a reason I'm doing that. Okay, I want you to realize something. I want you to see how even though relationships are the same, we need to find a way of determining the difference between, is this more strongly negatively correlated to this? See, they look almost identical to the naked eye, but we need to find out which one has a stronger connection, relationship. Which data set? This one or this one? Can you see how we're going to... Really exciting. Hopefully you find this exciting, because we're going to relate this to markets. We can see if the S&P has a negative relationship, for example, at one period in time to yields, but also has a negative relationship at one point in time to crude oil or FX, like dollar yen. Where's the relationship stronger? Which one should we be paying more attention to? Can you see why I'm doing this? Because I want you to realize that we need to be able to differentiate between relationships that are similar in nature, different in nature, and put a number to it to describe how different the relationship between this and this is. Okay. So one more final one. We're going to copy this crude oil example. I'm going to give you some different crude oil data versus the S&P 500. Copy and paste. Okay. What I'm going to do, if you don't mind, is I'm going to insert some cells here. Okay, and you'll see why I'm doing this, but just creating a little bit of a gap. Okay, so I've got some more S&P 500 data, so I'm just going to copy this crude oil chart down there. Select data. Okay. Edit. See, I don't want that data. I want this data. Crude oil. X values. I don't want those X values. I want these X values. I know I'm doing it a little bit fast, but obviously you can do it. Pause it and do it in your own time, slowly. Click OK. Okay. Can you see? Well, the reason I'm doing this, you can drag this up. We can compare the two. This is S&P 500 versus crude oil at one point in time. This is S&P 500 versus crude oil at a different point in time. Do you see how similar they are? Positive. Positive. The reason I'm doing this because I want you to realize, even though they're very similar, the correlation is slightly stronger in one of these, and it's very difficult to tell. Sometimes you can tell, but typically, and you can't, because you're not going to plot these scatter plots by hand. Can you imagine whilst you're trading trying to plot this and markets moving at 100 miles an hour, and it's just, you can't do it. You need some way of measuring which relationship is stronger, which one is more positive. Why is that? Because then you need to know how much weight can I put on my decision based on what I'm seeing in the other market, in the crude oil market. For example, if the relationship is very strong at one point in time and you see crude oil moving up, you might think, okay, that's makes sense for me to pay attention to that relationship. If you tend to see it all over the place, in this instance, it's quite positive, but let's say it's more like either that or something like this. This here. Crude oil and S&P are behaving like this. You can't make head nor tail of it. You're not going to really be confident if you see crude oil going up, and this is what's been happening the last 24 hours or the last month. Again, correlation can get very complicated because, how long is the sample size? Should you take a month? Should you take a week? Should you take a day? I've got my own opinions on it, which I'm going to share with you as we work our way through, but right now we still need to figure out how can we get this correlation coefficient, this number, that I can compare this type of relationship to this relationship to this relationship to this relationship. Just make sure I'm not covering those relationships, to this relationship, to this, to this. So it's just no good just saying, and this is ice cream sales versus temperature. But it doesn't matter. Let's imagine both of these were crude versus ES, and they were just at different points in time. Which one is more positive? Do you see? It's not just good enough saying, oh, well, you know what? They're both positive. Great. No. Which one is more? Is this one more positive? Is this one more positive? Is the relationship stronger? This could be January. This could be February. This could be Monday. This could be Tuesday. Is Monday got a stronger relationship than Tuesday? Do you see? We need to be able to differentiate. This could be a different market. This could be S&P versus yields. This could be S&P versus FX or crypto. Okay. The whole point I'm showing you this with so many different examples, because eventually I want you to move away from thinking about these. What it is, it doesn't matter. I want you to start thinking about correlation as a statistical measure, right? We can worry about, what are we actually measuring later. I want you to start thinking about part of the issue with correlation is you need to find a way of comparing different relationships at different points in time and figuring out which one is stronger, which one is weaker in one number, rather than me having to calculate this every single time I look at two markets. Do you see? Because if you're trading S&P, you're trading crude oil, you can't go through this. What are you going to do? You're going to start plotting S&P and crude oil prices on your Excel sheet and start. By the time the market moves, it's going to be old. It's going to be so time consuming for you. You need to understand this relationship in one number. Okay, what is that number? Correlation, right? It's the correlation coefficient. There are different measures. I'm only going to talk about the one that is most widely used. It's the Pearson correlation coefficient. It's the R value. It's correlation in one number. Okay. It measures the strength of the relationship between two variables. Okay, gets a line of best fit. It basically measures the correlation between these two variables in one number between -1 and +1. Okay, it's almost like standard deviation, right? So what I want you to do, I actually want you, if you haven't done it already, if you've got the pro course, I know some of you may not have it if you're doing just fundamentals. If you've done the pro course or you've got access to the pro course, or you might be on foundation and you haven't started pro course yet, I don't want you to look at this now. I want you to pause. You can absorb this, leave it to the side for the time being. Even if you've done the pro course, I want you to pause. I want you to go back and familiarize yourself with standard deviations, okay? Because we're going to be using variance heavily now, okay? And I don't want to basically go through the whole section on variance again. I think I did about 2 hours on variance between markets, describing standard deviation. Basically, what is it? How much does the market vary, basically, over time? What we're now doing is we're comparing what statisticians do to establish the relationship between two variables is they basically compare the variances, okay? And it's actually really straightforward if you think about it. If you remember what variance is, right? If you just think of ice cream sales as a standalone measure and you plotted it, right? And that was the variance, okay? So, the variance to the mean. Do you see why you need to go back to the pro or familiarize yourself with what variance is? Because I'm not going to cover it here, because I've done it for 2 hours, 3 hours in the pro course. So again, go and look at that section. Think about it. What is it doing? Let's say the average is, let's work out the average here. Equals average, double click on that, of these numbers. Okay, and hit enter. 402, and I'm just going to press this button to get it down to, okay, so 402 is the average. Okay, now let's say you have this number, 215. Would you agree? That varies. It's very volatile. It's moved. The variance is high. Now, if you've got 215, it may be down here. Would you agree? The variance, it's moved down, right? So it's very clever actually, and if you think about it, it's very straightforward as well. And think about it, really think about this. It's very clever the way statisticians have come up with this measure of correlation. Okay, what they're doing is they're comparing that variance at that point in time, 215, to this variance. Okay, so 14.2. So what they're doing, I'm going to copy and paste here. Okay, so this is the average of the temperature, 19. Do you see 14? At the same point in time that we had 215 in sales, we had the temperature of 14. Now imagine these were all the temperatures plotted in time. Okay, terrible drawing, but let's just say they were. The average is somewhere here, like 19. 14 might be down here somewhere. Can you see the variance? If you remember how I calculated variance in the pro course, between 14 and 19, It's negative. What's the variance between 215 and its average, 402? Negative. Do you see that? Negative variance. Negative variance. So what statisticians are doing is they're comparing these two and saying, what's the relationship between this variance of ice cream sales? If this doesn't make sense, keep rewinding it. It will. And watch the variance section. And temperature. Would you agree? Think of it. It's actually quite logical. If every time the temperature had a variance from its mean that was quite negative, we had a variance of ice cream sales from its mean of 402. Do you see? Very negative variance. 215 versus the average. 19 versus 14. The correlation must be high. Why? Because they're negative at the same time. They vary to some degree in the same direction. Okay? That's where you get positive correlation. Alright? And where you get negative correlation like this, it's going to be the opposite. Alright? So you're going to typically get the opposite happening. So in fact, just because my head might be blocking it, let's do it over here with add lengths. Okay? So I'm going to be a bit cheeky if you don't mind, and I'm going to copy these averages, copy, and I'm going to paste here. In fact, you can see I did that by accident, sorry, that should not be there. Okay, so, forgive me, I should not have copied that across. You can see I was messing about with them earlier, so if I copy and paste, there. So the average of the add, do you remember what we were saying? The shorter the add length, so it's a negative relationship. The shorter the add length, the higher the average rating. Here, the lower the temperature, the lower the number of sales. So more of a positive relationship. Okay. Now if you think about it, with a negative relationship like this, the variance, it's going to be the same, as in there's going to be a relationship, but the variance might be opposite. So what do I mean by that? Well, look, this might be a plot of the add lengths, the x, and this might be a plot of the average rating. Okay, so you have a line like that and a line like that, which is the average. Do you remember how we calculate variance? Go back to the variance section. Well, let's look here. 16 add length versus its average on this particular outcome. Do you agree that's below the average? Somewhere down here. 16 versus the average of 22. Look at the average rating. When the ad was really short, you got a high rating. Right? If the average rating is 5, but you got 10, look where 10 is. Way above. Can you see you're now comparing a negative variance to a positive variance? So your correlation is going to be negative. Okay? That is what correlation is. That's how statisticians measure correlation. Is they're looking at the relationship between the variances. Because if one thing varies from its mean positively and the other thing varies from its mean positively, they're both varying positively at the same time together, there's a relationship. Alright, now what I'm going to do is I'm going to show you, it's called covariance, okay? It's a measure used by statisticians to look at this relationship, basically. It's called covariance. So what I'm going to do is I'm just going to tidy this up a little bit. Let's put a box around this. Okay, make this bold. Let's write average. Just very quickly going to tidy this up. Okay. No border, so let's tidy this up, average. Okay, so now we're going to calculate the variances. Okay, so variance A variance B. Okay, I'll just copy the format. Okay, equals 14.2 minus the average. I want to see how much is it varying. Okay, now I'm going to press F4. Okay, what that's going to do is just going to lock it in. Okay, I'm going to press it twice. Okay, so in fact I'll press it once. Okay, and I'll tell you why in a second, because I just want to be able to move it across. Okay, so I'm going to hit copy, paste it across, paste. Okay, so if you see what I've done there, the reason I've locked it is because I don't want to keep having to do it individually, so it's just 18.5 minus 19. Do you see? And then I'm going to copy, escape, copy this, and paste it here. Okay, and let me just make that one decimal place. So basically what's happening here, and I've said this before, you need to go back to the pro section and check the variance if you have any confusion over this. I want to see the variance, individual variance. Remember when we were calculating the standard deviations of temperature, right, on its own versus the average. So when it's 14.2, it might be down here. The variance from its mean is quite large. Do you see that's the variance? Minus 4.5. Minus 2.3, minus 6. And then I want to compare it to the variance of ice cream sales. So 215, as we already said, is way below 402. Right, 215, way below 402. So let me start again. So I might have a load of plots of ice cream sales. The average is 402. Oh, I got sales at 215, down here somewhere. The variance is very negative. Can you see? Minus 187. Then I can compare them together and look for a relationship, because think about it, if the temperature varies from its mean negatively by quite a large amount, at the same time sales vary from their mean, a negative amount, large amount, there's a positive relationship because they're both doing the same thing at the same point in time. Okay, that is correlation. It's you see, it's covariance. How do the variances relate? Covariance. Okay, that is what that is. And if you remember, I'm not going to go over this again, but if you remember, the variances have to sum to 0, right? And I'll show you that. I hope they do anyway, otherwise I've done something very wrong. If you sum these together, 0. Do you see? Variances from the mean as a sum can never be anything but 0. So those will be 0. We're just going to make these all borders, and then we're going to calculate the covariance. Okay, covariance is very easy. All it is one variance times the other. Okay, just make that nice and neat. So equals that times that. Copy, paste it down. Okay, don't want any decimal places, get rid of that. A times B, and let's just get the same format, so format painter. Okay, now the covariance is just the sum of the variance A times variance B. Why is that? Because think about it. If the number's larger, it means that the relationship is stronger, right? Because if think about it, if the variance of A moves a big amount, and at the same time the variance of B moves a big amount, so you're multiplying two big amounts together, you should get a big amount. So the bigger the amount is, the higher the correlation. Okay. Now it may not make sense straight away, okay, but if you think about this enough, it will make a lot of sense. Sorry. There's no other way of understanding it than doing the example. If you do it 100 times, and it will eventually click. So that's the covariance, 5,325, which suggests that it's quite large. You'll see why there is some adjustments to this, because it's a little bit like, if you remember, having to have a standard deviation so we can compare, right? A standard deviation number. In the same way, we need a standardized way of comparing this covariance to this covariance to this covariance to this covariance. Because can you see, these absolute numbers are driving that covariance. Think about it. If these numbers became very small, like, let me just show you, 2. I'm just making this up. All of them became very tiny. 2, 2, 2, 2. I'm hoping the covariance should shrink. 2, 2, 2, 2, 2. There you go. 5. Do you see how tiny that covariance became? Right, just small numbers, basically. It's kind of a mathematical effect as well, because you're multiplying small numbers together now. See, these variances are going to become very small because your sample size, the numbers are small. That's the reason. Let me just undo a lot of that. You can experiment with this on your own. See, the covariance is heavily influenced by the unit size. But we don't want that, because sometimes we might want to compare the S&P and crude to crypto and something else. And the unit sizes are all going to be different. So we need a standardized measure of doing that. Okay, so the way we do that is we use something called Pearson's correlation coefficient. And all it is we're just dividing by the standard deviation. The sum of the standard deviations of both of these. Okay, so it's the covariance of A and B. Okay, so temperature and ice cream sales. We've got that now. The covariance divided by the standard deviation of A times the standard deviation of B, so that we can compare all of them. Okay, so we're going to quickly do that together. Give me 1 second. Okay, so first thing we need to do is get A squared, so A squared and B squared, okay, equals the variance squared, right? So variance. Do you remember for standard deviation, again, you could go back to the pro course, but the standard deviation, do you remember we squared all the variances because they sum to 0? So you need to get this, you need to square them so they don't sum to 0. So I'm going to calculate the standard deviation. I'm not going to go over how to calculate standard deviation. You should know this from the pro course. You'll have to go back. So we're going to do that, and then the little hat times 2, that is squared. Hit enter. Okay, and I'm going to make that 1 decimal place. Copy and paste. Okay. These are no decimal places. So A squared, do you see all it's doing is just squaring them? Okay. Variance A squaring each time. Variance B being squared each time. Basically, I'm calculating the standard deviation. Okay, exactly as I've done in the pro course, I'm calculating the standard deviation. So all of them squared. Then I'm going to sum them, equals sum. Okay, so 177. Copy that over, or just do it manually, equals sum. Okay. So sum of the squared variances, right? Remember from having to calculate standard deviation. And then finally, we're just going to do the square root. So square, I'm going to use Excel for this, square root of that. Okay, and we can do it here as well. Equals square root of that. Okay, so that gives us the standard deviation. And then don't forget, the formula for correlation is the that's awful, isn't it? Covariance x and y over the standard deviation x times standard deviation y. Okay, so you're standardizing it. So we need to multiply the two standard deviations together. Let me just tidy this up a little bit. I'm just going to move these and right align them. There you go. So this is standard deviation, standard deviation. We're now going to multiply them together. So simply equals that times that. So you see it's giving us a number for the bottom part of the formula. Let me just do this a little bit more clearly. Okay, so it's how do the variances vary, co-vary of the two variables, x and y? It can be the S&P and crude, it can be ad length and average rating, it can be ice cream sales and temperature, whatever, over the standard deviation of both multiplied. Okay, so we got the covariance 5325, we multiplied the standard deviations together, which is that, equals correlation basically. So we're almost there. Equals the covariance over the sum of the standard deviations equals 0.95. What that's saying is they're almost 96% correlated. The linear relationship can be 96% explained by the movement in one to the other. Okay, 0.96. Okay, so it's just a ratio between the two of them. Now, if you don't mind, I'm going to just clean this up a little bit. So I'll just make this look nice. Bold, and let's call that correlation. Okay. Okay, that. And this. Just clean this up a little bit. So if you go to this, it will say more borders. You can just clean these up. I'm just removing the bottom two. Okay, do you see what I'm doing there? Borders, more borders. I just removed that bottom one. There you go. See, nice. Correlation is 0.96. And I'm going to show you there's actually a formula in Excel called correlation, and it should be equal to 0.96. Otherwise, I'm going to look a bit silly, but I think it should be alright. Correlation, and you just select the arrays. So temperature, comma, ice cream sales, and hit enter, and Excel will calculate the correlation for you. 0.96, okay, to one decimal place. So we got the calculation right. What this is saying is it's a very strong correlation. Maximum is 100% correlated, 96% correlation. You see what it's doing is it's standardizing the variances. It's the relationship between the variances. If you understand standard deviation and you did the exercise properly in the pro course, this should make a lot of sense to you. What it's saying is there's a 96% strength between the variance of temperature cells to its mean, or 96% connection between the variance of temperature to its mean to ice cream cells to its mean. When you compare the two, there's a 96% fit between the relationship. It's very strong and it's positive. Okay, we're now going to quickly do it for all the others.